I'm calling this one boiling point. It certainly brings up a picture of just how hot and crazy our Perth property market has become. I'm going to go into exactly what's happening in the sale market, the rental market, the factors that are driving our market, and the indicators for what's ahead, as well as my crystal ball and actions to consider and ways we can help. I had my biggest turnout to a home open ever with 59 buyers through the other weekend to a villa in Cannington, absolutely plain Jane dated villa in Cannington that we did present well, and we sold it for 115,000 higher than asking price. 1,100 plus clients and properties we manage. To have less than 5 people developing something is crazy and just shows how little supply is getting created for both land and for units and subdivided houses. The other thing that I think is an absolute essential, which I see as being a big mistake that people make, is they go out and try to build a portfolio without having absolute clarity on what their plan is and what's the most optimum way to do it.
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management, sales and buyers agency servicing the whole of Perth. Now, here's your host, Jared Mann.
G'day and welcome to my Perth property market update. It's my final one for December 2025, and I'm calling this one boiling point. It certainly brings up a picture of just how hot and crazy our Perth property market has become. I'm going to go into exactly what's happening in the sale market, the rental market, the factors that are driving our market, and the indicators for what's ahead, as well as my crystal ball and actions to consider and ways we can help. So buckle up and get into the pot with me, because things are crazy hot at a boiling level. And let's take a look at exactly what I'm talking about. So in the Perth sale market, the number of properties for sale is at a very crazy low level of 2,918. It's gone up slightly since 3 months ago when I came to you, but we're still 48.5% down on the December 2024 levels. So that is just absolutely tight. There's so little for buyers to choose from. Many buyers are sitting tight that would like to sell and upgrade and change over just because they can't make a subject to sale offer, or they're worried about selling and not finding something. With the rental market still being so tight, it's hard for them to move in and rent. So that's all contributing to very little supply of properties available and keeping upward pressure on prices. And when we look at the number of properties being sold each week, it's still at very strong high levels of around 900 sales per week over the last month. And that's been trending sideways almost for the last 4 years at sort of similar levels. It's around 8% decrease on the monthly sales figures for December of 2024. But because there's so little supply, I think if we actually had more properties to choose from, there'd be more getting sold. So that's to be expected, and no real change to the demand side of the equation. Now, when we look at the sale inventory, that's also remained low. So that's a sign of how little supply there is, just 0.78 of a month of supply. So at the current rate of properties being bought, all would go in 0.78 of a month. So that's 43% down in the level of inventory since December 2024 as well. Now let's take a look at the median house prices, because we did hit a slower point earlier this year, but things have continued to rocket up in the second half of this year. And we're now with a median house price of $825,000, and that's 11.5% up on last year, where last year we were at $741,000. So pretty decent overall growth in the median house price. And keep in mind, there'll be suburbs that have done much better, suburbs that have done much worse. And when we compare that with what units has done at a median level, it's increased from 495,000 to 580 for units, and that's a 17.1% increase. So I predicted and forecasted about 18 months, 2 years ago, that units were going to close the gap and activity was starting to bubble in that market. It's certainly gotten to hot now as well. And really, when I talk about it boiling, the unit market's what's probably most boiling at the moment. Affordability is starting to bite people in houses and push them down into that more higher density form of housing with villas and units. I have had some absolutely crazy things happen this month. I had my biggest turnout to a home open ever with 59 buyers through the other weekend to a villa in Cannington, absolutely plain Jane dated villa in Cannington that we did present well, and we sold it for 115,000 higher than asking price with 59 people through. I had 22 offers. It was a absolute crazy time to negotiate that many through and play them all off against each other, but someone absolutely just wanted to get into the market. 2 weeks before that, I had my next biggest turnout to a home open with 49 people through a villa in Inaloo, and I sold it for 161,000 higher than asking price, which is absolutely insane. And keep in mind, each time when I'm pricing these properties, I'm pushing the price and already positioning it to be quite high, and looking at all the most recent sales and what's under offer to do that. So when you wrap a strategy, like I've got my 6 point strategy that I put around a sale, in this market, you can really amplify the result if your strategy is really, multi-layered and on point for selling. And people ask me, oh, well, should I just sell the property myself because the market's so hot? But a great agent in this market can amplify the result by even more than they can when the demand isn't going with the market. So pretty crazy. I mean, can you imagine that phone call when I go call to tell my owner, my seller, we've got a great result, 25 offers, and this is the case of Vinaloo, 161,000 higher than asking price. He was in shock. He didn't know what to say. He fell off his chair. So, but still, it does break my heart on the other side of things, because with 25 offers, 24 buyers that missed out that still don't have a place to buy. And that kind of level is just crazy. So if anyone does have a villa in a prime area, or even just the more affordable areas as well, let me know if you are looking to sell, because I've got lots of buyers in lots of varied price points that I can put it out to. And I'd certainly want to get a record price when selling your place as well. Now, finally, before I move on from median prices, this one's snuck up on me a bit here, because the actual change in the median land price has gone from 310,000 to 389, which is a 25.4% increase. And we can see that land is actually leading the way with the rate of its increase over the last year. So people are moving to land and moving to build. Land is not really getting created, but anywhere near fast enough. Infill development's not happening readily. I could count the number of clients on one hand that are doing a project at the moment out of 1,100 plus clients and properties we manage. To have less than 5 people developing something is crazy, and just shows how little supply is getting created for both land and for units and subdivided houses. The reason for that is that the development numbers still are not stacking up, because the house price, the cost to build, has increased by so much that the established prices still need to go higher to make the profit margins work. And the only sort of price points that I'm seeing a development work well in is the higher end price points, where, if you build in Midland at the moment, you might spend 400,000. But if you build in Nedlands, you might spend 600,000, only costs 200,000 extra, but you may get 800,000 extra in the price, and you've got a lot more margin to work with, even when the land price is higher there. So if you've got a property in a higher end area, worth looking at the numbers if you've ever thought about doing a development. If you're in the lower end area, probably still not worthwhile. Now, let's take a look at the median selling days. So when I last came to you 3 months ago, we were at 11 days, and it had started edging back up there. You can see that in the March quarter, I think we hit about 14 days on market or something like that. But since March, it's continued to tighten back again. So at 11 days 3 months ago, we're now at 8 days, which is in line with the lowest level that we'd ever had back in September 2024 when we were last at our hottest. So I've never seen it go tighter than 8 days. I'm not even sure it ever will, because think about it. Properties go on the market on a Monday, Tuesday at the earliest in a week. And then by the time we do our first home open Saturday, Sunday, wrap up all the offers, it's usually Monday. And there's your 8 days as the median selling time. So we're not generally going to get quicker than that if we want to be doing the best job for our seller and making sure we've got all the interest together to get the best price. And so I don't think that can get any lower. When we look at the rental market now, the number of properties for rent has remained low at 2,246, super tight. We've had a 2.1% increase in number for rent over the last year to December last year. It started to move up a little bit earlier this year and soften in certain areas, but things have tightened up across the board. Again, we've got 15 for rent. We're trying to get them all rented before we hit Christmas. Really crucial at the moment if you've got a property that's vacant to make sure that it's marketed really well, priced really well, and that you find a quality tenant before we hit mid-December, because otherwise your property is likely to be vacant and cost you extra money. So usually when you do your numbers, if it's going to be vacant 3 weeks, you can take that weekly amount, divide it by 52, and just make sure that you're priced right, because you're going to lose more in the vacancy than you would in adjusting the price if it needs to be a bit more attractive to find someone in time. Now, the rental vacancy rate has also remained at its low level of 0.7%. That's unchanged since December of 2024. Our vacancy rate's at 0.6%, so in line with that. The median rent for houses has remained at $700 per week, and it's had a 7.7% increase since last year. Our median rent for our portfolio is at $671, so that's continued to increase, and now that we can only pass on one rental increase every 12 months, we're really sort of pressing to negotiate the best increase that we can, because you can't increase every 6 months anymore. Now, rental inventory, like our sale market, super tight. It's at 0.79 of a month compared to so that's the supply, compared to the rate of take up. And it's had a 4% increase since December last year, so very minor. And when we're talking, such low levels, it's barely even noticeable in the change. Now, let's take a look at the property clock timing, how Perth compares with the other capitals around. We are sitting still in a rising market. Interestingly, they've moved Albany and some other regional areas back around into a rising market. When I say regional towns of WA, I'm talking about. They've moved Melbourne around into starting of recovery. So we've definitely seen that over with our buyers agency side making some purchases there, but we're still predominantly focused on Perth because the opportunity is really best, I think, here for the next 1 to 2 years, and Melbourne's more of a 2+ years. But if we're buying right at the moment, in certain areas, we should still get good growth over the next 12 to 18 months. No other major changes since I came to you on the national property clock. When we look at units, we had Melbourne move around into starting recovery. We had the southwest of WA units move back around into a rising market. So definitely, it's funny how the regional areas usually lag Perth, often by 12 to 18 months, and they're having their second wind now. It's clear. So interesting to see that the regional areas are increasing in price again strongly. Now, when we look at the 3-month changes in the Cotality Index, Cotality was previously CoreLogic and previous to that RP Data. So this is one of the best indexes that is worth following. We can see that the 3-month change has had Perth back at the very top of rate of change of price growth, in line with Darwin. So a 5.4% change, and Brisbane is second to Darwin and Perth with a 4.9% change. We've then got Adelaide with 3.2, Melbourne 1.6, Sydney 2.3. When we look at the 12-month change, Darwin's still sticking up there as the top of the tree with 15.4%. Brisbane 10.8, and Perth with 9.4. So Perth's definitely having its second wind. And if we looked at annualizing the quarter change, we'd be on track for a 20+% price change. So interesting. I don't think it's probably going to continue as fast, but I think we're definitely going to be on track for very strong growth over the next year. And I'll let you know my predictions a little bit later on for the specific price points. Now, how have the price points actually been going over the last 3 months? When we look at the lower end, it's done 6.2%. That's the lowest 25% of value, 6.2%. The middle has done 6%, and the top end has done 4.5%. So if you annualize that 6%, Jesus, it's on track for 24+% growth in the lower end and the middle. So that is nuts. The only other areas across the country that have done better is Darwin with a 7% at its lower end. And that's the only segment across the board that's done better than the two segments of Perth, the bottom end and the middle end of Perth. Now, when we take a look at what's happening with rental yields, Perth is still holding pretty solid with a 4% rental yield. There's only Darwin, Hobart, and Canberra that are above it. Generally inferior, sort of more riskier places to invest. We've then got Adelaide at 3.6%, Brisbane 3.5%, Melbourne 3.6%, and Sydney at 3%. So really harder to hold a property when you're going into these other capitals. And the reality is that even with Melbourne and what we're looking at over there, you typically had a 2.5 to 2.75% yield compared to a 4.5% yield for a similar sort of price point here. So an extra 2% coming up in your holding cost is very difficult for any investor to reach into their pocket for. The market will catch up and grow in its rents, and that's part of its cycle that it needs to go through. But it's a lot easier to hold a property in Perth still.
Just real quick before we continue on with the episode, are you getting my email updates yet? If you're not, you're missing out on our suburb intelligence reports, which we tailor and prepare for your individual suburbs of interest, showing advanced stats and insights. Must get onto those. And I also send out exclusive invitations to our events, including webinars, sundowners, and workshops. So if you're not getting those, head on over to investorsedge.com.au/join and make sure you're receiving my email updates.
Now, let's take a look at the factors that are affecting our market. And this is where I look under the hood and unpack the important things that are going to drive growth and affect overall prices. So with finance, we've had rates left on hold in October and November. The RBA was previously talking about further decreases, but they're off the cards for now because we did have a higher than expected inflation rate, and I'll go through that in a second. And when we look at where we're at with our cash rate at 3.6%, the longer term neutral rate is considered between 2 and 3%. So we're still on the slightly higher side. The actual rates on offer from the banks are 5.25 to 5.75 for most people. And when we look at the share market, the ASX futures is pricing in no further rises now. And I haven't updated my slide there, but they're pricing in no further rises. And when I look at the expectations for next year, they're expecting some potential slight increases towards the very end of next year. So previous to that, they were expecting decreases across next year, and they've changed their mind on that. So look, it's a moving target. We'll see what happens with inflation and then what the RBA needs to do to try to keep that in line. It's a more complex and bigger picture than just changing interest rates. As you can imagine, the government probably has the most levers that they can pull, and it seems like they're not in control or doing enough, just from my outside perspective. It'd be worth listening to episode 261, where I had Nick Aves on from Purely Finance, and we looked at the finance forecast and how borrowers can win in a shifting market. So if you haven't tuned into that episode, that was last week, go back and check that one out because it was a really good episode. Now, when we look at the inflation figures, we had a spike up across December from 3% in August to 3.6% and then 3.8% in October. So that has been driven mainly by housing, food, and recreation costs. I know there's a lot of talk in the media about energy or electricity costs driving the underlying inflation of a lot of things. And yes, it would be leading to increases in food and increases in all sort of costs. But the actual increases in the inflation were mainly driven by housing, food, and recreation, so not directly related to electricity or energy. Now, our peak for inflation was at 7.8% in December 22. We thought in recent, over the last 6 months that it was under control. We were down to 1.9% in June. And then since June, we turned our back and it's continued to increase to 3.6, 3.8 now. So it's trending back the other way since June, and they need to really look at reversing this trend. When we look at what's happening in the stock market, we've had a bit of a decrease since the end of October going into November. Been checking my shares and seeing things decrease off of their high. We're still about 2% up on last year's all ordinary stock market index value. So a bit of a heat has come out of that high that we had to the end of October, and it's come out quite quickly. So I'm no share market expert, but I do look at it because I want to understand the wealth effect. And when people are generally making more money, it tends to go into properties. So overall, people are in a pretty, we're at a still historical highs. It's still up on the same time last year. It's had a bit of a resurgence over the last week. So I guess where that'll head, we'll have to see in our next quarter's update. Now, when we look at the iron ore price, it's relatively unchanged on a quarter ago and hovering about at its longer term average over the last couple of years. So nothing drastic or unexpected to report in that area. When we check out the population growth, we've got the latest stats came out to March. We still had the highest overall percentage change in population growth by a long shot, with 2.3% change over the previous year. The next highest were Victoria with 1.8%, Queensland with 1.8%, and overall Australian average was 1.6%. So Perth still leading the way with population growth. Where that's coming from is mostly from net overseas migration, but we're also getting some good net interstate migration, and people are still leaving New South Wales to go predominantly to Queensland and WA, and there's small amounts of people leaving from Victoria, Tassie, and Northern Territory and ACT, with the only two states that have got positive net interstate migration being Queensland and WA. So a lot of people moving to the places that have got the best lifestyle, and with a real great feather in our cap that people are coming here to WA. Now, when I wanted to periodically take a look at the labour market and any changes that are happening, because employment is really key to people affording to pay more for prices, and it gives us a really good benchmark for the overall state of our economy. When we look at job vacancies and how many are being advertised, there's been a noticeable fall over the past 2 years, but they've stabilized in recent months, and it's above pre-COVID-19 levels with the number of job vacancies. So still a very difficult market to find staff in. There's 26,207 internet job advertisements in September 2025. And that's 4.4% more than the previous month, but 6.5% less than 1 year ago. So still a very strong labour market and lots of job opportunities on offer. We don't want things to be too crazy, because businesses, if they can't find people, can't hire people, then they therefore can't grow, and then our economy can't grow. And so that's an issue as well. So what we're looking for here is a bit of a balance so that people can find staff, but we don't want, job vacancies going down the toilet as they did around 2020, 2019. We're at fairly low levels as well. So we'll keep a periodic eye on that, but all looking good. Now, policy changes and impacts. let's check out what's been happening at the state level. Now, the one I wanted to mention to you is that there's been big planning reforms announced for high density housing to be around the 10 train station precincts in Perth suburbs. And they're basically taking that out of the local council's hands and putting it with the WA Planning Commission. And they're going to set the zoning and the height density rules within 800 metres of those train stations. So the implication here is that it's going to unlock a lot of apartment and unit developments in those precincts, increasing housing supply. And I think overall it's going to be very positive to the values of those that have a property in those areas. I'm going to do a deep dive episode coming up where I look at what's proposed, what the pros and cons are going to be. You can bet that the local councils have got a few things to say about it, especially the Western Suburbs councils. So I think a change like this, although it may not be entirely popular, is what's needed in order to get extra housing supply and try to give buyers more affordable options. Everyone doesn't ever want them in their backyard, but it makes sense to put higher density around the transport nodes, which will then also have other amenities and bring these town centres to life in the way that they were intended to do and not be held up and blocked by councils. So watch this space, and I'll be in touch with an episode to run through that soon. At the federal level, we've had the AUKUS Defence Project confirmed, which has got a major impact on WA. It's a massive game changer. It's set to become the second biggest industry for Western Australia. And you can go back and listen to episode 253, where I deep dive on exactly what's proposed and how that's going to impact Perth as a wider economy and then the local suburbs around that area. The next big policy change at the federal level was the new rules that are looking to be adopted by APRA. So APRA is the governing body that sets policy for the banks. I think that's the layman explanation. It might not be 100% accurate, but that's what they do. They have set a debt to income cap on new home loans now. So what that means is that from the 1st of February 2026, APRA will limit the proportion of high debt home loans that a bank can issue. Specifically, no more than 20% of a bank's new mortgages may go to borrowers whose total debt is 6 times or more than their gross annual household income. And this 20% cap is going to apply separately to owner-occupiers and investor loans. The rationale that they've come out with is saying that rising rates of high debt-to-income lending, especially among investors, create systemic risk when combined with high household debt and surging home loan demand. So what this really means is it's going to be harder to grow and build a portfolio, especially if you're stretching and pushing your borrowing capacity. It's going to be even more important to work with a finance broker because different lenders are going to have different policies, and lenders are going to be capping the number of investors and home buyers that they will lend to with on the higher end of their debt to income ratios. So the impact, I think, is going to be on taking some investors out that would otherwise be able to. And what you've got to watch out for as an investor is to not push things too hard, because it might mean that you won't be able to refinance, or it'll be very difficult to. That's why when I create my strategic portfolio plans for people, I'm always sticking to a 6 times figure for their borrowing capacity compared to their income. So watch this space. We'll see how these changes unfold and whether it's going to create much of an impact at all. But it'll definitely slow down some of the more investor demand, especially from those that are pushing their portfolios to more of the limits. Now, let's take a look at the tips to survive and thrive. It's still very good value buying and solid rental yields on offer in Perth, but you need to be selective. I'd push your budget to the middle or top end suburbs. So we've really gone out to a lot of our clients that had a budget of 800K, and we've tried to get them to at least push above 850, because that's where the cutoff now lies for first home buyers to use the home buyers deposit guarantee scheme. So if we can just be able to pay 860. Many of the first-time buyers will cap out at 850, and that gives us, a little edge when we're going in to negotiate against them. I'd consider getting into a villa or apartment still if your budget is below 700K and you're priced out of houses. And definitely get in touch with our buyer's agency service, because we can make a massive difference both in preventing you from paying an overly emotional price and paying too much, as well as our suburb selection using our trifecta method to give you the best chance of high performance. It's easy to go and find something that's going to perform strongly over the short term, but what we're trying to do is select something that's predicted to perform in both the short term as well as strong fundamentals for the medium and long term. So that's where it's much harder for suburb selection, and you do need a proven methodology to do that, which we have. So I think you should focus on continuing to increase rents when you can and make sure you're paying the lowest interest rate, because all of that's going to help with reducing your holding costs. Now, the other thing that I think is an absolute essential, which I see as being a big mistake that people make, is they go out and try to, build a portfolio without having absolute clarity on what their plan is and what's the most optimum way to do it. So consider getting our strategic portfolio plan where we model everything out. We review your existing properties using our trifecta method to see if they should be in your portfolio. We really look at how the best mix of properties is going to, suit you and get you towards your goals for passive income and equity. And depending on which stage you're at, when you start to transition down, we look at how to do that and when and if you might need to sell any assets to convert them to other assets. So my crystal ball over the next 12 months, I'm expecting rents to rise by a further 5%, so slowing rate of increase, but I still think that it'll be a positive increase. Immigrants are still favouring Perth, and we should have strong population growth still, so that's going to keep putting pressure on rents and on house prices. There's going to be more local investors that continue to buy, attracted to reasonable price and using that equity that they've got in their own homes. I'm expecting, and I've upgraded this. I was only expecting a 5 to 10% increase in house prices in the lower end for properties under 900K, but I'm expecting a 10 to 15% increase now. That may end up being too light and could be a 15 to 20% increase. I'm expecting at least a 10 to 15% increase for the $900 to $1.2 million price points, and I'm expecting a 5 to 10% increase for the $1.2 million plus price points. So the market growth is rippling through, and as people get more for their lower end properties, it'll move to the middle, and then middle will move to the top as we round out our cycle over the next 18 to 24 months, and that could take much longer. We've seen the cycle continue in Brisbane and Adelaide longer than they thought, so it really makes me think we've got a longer runway ahead too, and all of our fundamentals are very solid still, and there's really any changes on the horizon yet. Now, for further help, if you're considering sale, get in touch for a complimentary appraisal. Go to investorsedge.com.au. It's me that handles our property sales personally. So you get to work with me on, and I'll focus on setting a record price. Over the last 3 months, I've sold properties on average for $65,000 above asking price, setting a record on all instances except 2 out of some 20 odd sales. So definitely get in touch, and we can look at how to use my 6-point strategy to look at getting you a record price on your property. For property management, get in touch for a custom quote. Go to investorsedge.com.au. And if you're not getting my suburb intelligence reports on your suburbs of interest, join our property investor update and go to investorsedge.com.au/join. They're well worth getting. And finally, as I mentioned, we're getting great deals on our buyer's agency side, needing to be a lot more selective. And it's definitely worth having a strategic portfolio plan if you don't already. So go to investorsedge.com.au/invest. Thanks for tuning in today. Hope you've enjoyed this market update. I really appreciate you listening to the podcast over this year. And if it's the last time I'm in your ears before Christmas, I hope you have a wonderful time with your family, a good break. and you come back supercharged up for 2026. And from all the team at Investors Edge, I just wanted to thank you for trusting us with your most important property decisions. And we get a super buzz out of helping you improve your life and create the wealth to do that. So thanks for tuning in, and catch you again soon.
Just a reminder, the information discussed in this podcast is general in nature. As we don't know your specific situation, you should always seek professional advice before taking any action. For free market reports on your suburbs of interest and other helpful resources to grow your wealth, make sure you join my property investor update at investorsedge.com.au/join. And finally, make sure you're a member of our Perth Property Investment Facebook group to be part of the conversation with other like-minded investors, get help to your questions, and get a feel for what's going on out there in the market. I'll see you in the group.